Hello, Louis Yanis. Hope you're doing well. Today, I want to talk about the power of formulas and distilling down wisdom that you've had for many, many years, that you've developed and created for many, many years, and how you can use formulas to actually help you do better at whatever it is that you do, and also to add a heck of a lot more value for people. As you may know, I've been in the investment management business for a long time, over 25 years. And over the years, I've been able to manage money for lots of different types of people. And there's a lot of wisdom that you learn from doing things well, having experiences, doing things not so well. And what I wanted to do is share some ideas with you in terms of how formulas can really help you. In some ways, I don't like the concept of a formula because it kind of sounds like we're boxing ourselves in. But there are some concepts that are fundamental to what you do, no matter what it is that you do in your life as a profession. There are some formulas that are fundamental that if you just use your noggin and you leverage off of those fundamentals, that you will actually have a much bigger impact. So there is, I have in front of me here, and maybe I'll pull this around here after a while. I'm going to read through them just to kind of go over them with you. There are, let's see, I'm showing you 1, 2, 3, 4, 5, 6 formulas that if you look at what's inside these formulas that are very simple, and they're basically acronyms, letters that are acronyms for processes. If you look within inside them, there's a tremendous amount of wisdom, and they generate 80% of the results that an investor is going to achieve based on my experience. So what I want to share with you is really not necessarily, yes, you should hopefully get something out of some value out of learning these formulas, but more importantly, the concept of how you can use your own thinking, whatever it is that you're doing, and use formulas and use acronyms to help you get a better handle about how you want to deal with things. So I'm going to start off with portfolio construction. So one of the things that we do is we have to blend investments together. And when you blend investments together, that's called portfolio construction. So you can think of it kind of like a recipe, like when you're baking a cake or if you're making any kind of dish, the amounts of the ingredients that you put in and the quality of the ingredients and what proportions has to do with how well that dish is going to be. Same thing with portfolio construction. And the portfolio construction has to be designed to the taste for the goals of what a particular investor has. So there is actually 3 main things that we look at. And there's a lot of little subsets to it. But the 3 main things I call SRC. And S stands for signal strength, which is basically to what degree is this particular investment attractive based on its cash flow and based on criteria for that particular type of investment. So signal strength, it's like an opportunity score, if you will. The second would be risk. So it's SRC, right? So R stands for risk. And risk has to do with risk in a couple of different ways. One would be volatility, how much it moves. And then the other would be the fundamental risk. In other words, how uncertain is that particular investment. And the third is C, which stands for correlation. So when we're looking at correlation, we're looking at how much do these investments move up and down with our other investments. So that's how we look at constructing a portfolio, SRC, signal strength, risk, and correlation. Now, in terms of the correlation, we also look at it a couple of different ways, right? There's a couple of different dimensions. One dimension has to do with the fundamental correlation or the drivers themselves and how they are correlated to investments. And then the other has to do with statistical correlation, which is what is demonstrated in the returns themselves and the investments relative to others. So this is a real art. And from years of distillation, we've been able to come up with, and there's a lot of things behind these, but the signal strength and the risk and the correlation are really important for putting together a good recipe for your portfolio. So another really important formula, if you will, that's worked well for us over the years has been equity selection formulas, how to pick stocks and how to be a winner in the equity market, how to take the odds and lean them in your favor so that you're profitable. And the very first acronym that I invented happened well over 25 years ago. I call it QVT. And we still use that today. Q stands for quality, which is what is the knowability, like how certain are we of the cash flows of this investment? What is the financial position of that company? And then value has to do with how much are we paying for that investment, given its assets, growth, and cash flows. And technical has to do with the supply and demand for the stock itself. Is there an increasing demand for this stock relative to supply so that we have a catalyst that we see that stock starting to move higher? So those three things can really improve stock performance if you're looking at those, each company from that. And I've made further refinements to this. I've also added more recently another acronym I call ADP, because many times you can have a stock that has these QVT variables, but if they don't have the ADP, which is the adaptability, the ability to be able to adapt to technological change and the change in environment, and D stands for the desirable product. If they don't have like products that people absolutely want and there's high desirability for the service or product, some differentiation, and they have to have a P, which is position. They have to have a position that they stand out. If you look at a stock and you add the ADP criteria to it, you have a much better probability of having a winning stock. So these formulas are not based on what I think, they're based on actual experience of successful winning stock trades and investments that we have had over the years. And another thing is, let's just take the technical side. The technical side is the supply and demand for the stocks themselves. A long time ago, I did a presentation for a investment management group years ago, and I came up with this concept that I use every day. And it came from experience, but I distilled it down to acronym I call TORQ, T-O-R-Q, T-O-R-Q. And that helps us identify companies that technically look attractive. And the first is trend. T stands for trend. What is the actual trend in the price? The second would be your overbought or oversold condition. Overbought or oversold condition. Has the stock run up a lot or has the stock run down a lot? So, because typically stocks can have mean reversion moves the opposite direction if they move very quickly in a certain direction. So overbought, oversold. And then R stands for relative performance. How is this particular investment performing relative to other investments? Because relative strength is a very powerful factor in helping determine returns in the future as well, especially in if you look at intermediate term relative strength. So that's R. And then Q is quality patterns. There's behavioral patterns in the market that you can identify where there is usually it has to do with volatility contraction, right? And when you have contracting volatility, you can have an expansion in volatility later, and that pattern can lead to a move. So TORQ is a very, very useful way that anybody can learn how to technically read a chart for a stock or a bond or anything else. Another thing I wanted to mention has to do with really with anything packaged. Like let's say you're managing, you're putting together your portfolio and you have a 401k, or for some reason you need to have a packaged investment. Packaged meaning an investment like a mutual fund or an exchange traded fund or a hedge fund or something like that. There's always this concept of the 4 Ps. That's very, very powerful. If you just look at that investment from the standpoint of people, who's behind it, and what is their track record, and do they have a track record of success, right, their organization, and the other P is their process. What is their process, and does that process make sense? Is it likely to be replicatable in the future? And then third is their performance. How is their performance relative to their peer group? How is the performance of this compared to others that are similar? And then the last would be price. How much am I paying? What are the expense ratios? What is the turnover? What is the tax cost? And if you put those 4 things together, those 4 Ps, that could help lead you to making better choices regarding any packaged investments. So I know I'm talking fast here, but I'm telling you, there is a ton of wisdom in what I've just been giving you in these simple acronyms. And if you dive deep into them, you will increase your investment performance. You have a higher probability, based on my experience, to have better performance. Of course, there's no guarantee, and past performance doesn't equal future results. But there is a logical reason why these should work in the future. And I'm going to leave you with this last formula. This last formula is a relatively new formula that distills the elements of portfolio construction And it combines that with the elements of selection. And it's a little bit more complicated, but it's 3C plus 3P plus SA. 3C, so there's 3Cs. That has to do with your customers, your competitive advantage, and your costs. So who are the customers that are involved with this particular company? Do they, and there's a lot we can get into in each one of these, right? And then what is their competitive advantage? How are they different? What's that competition? How are they getting an edge in the competition? And their costs, how volatile are their costs? How can costs go up? How are their costs structured? That has a lot to do with things. And then the second part of it has to do with the 3Ps, which is people, position, and performance. People, again, talks about the management team. Performance has to do with that torque ratio that I mentioned to you before, the technicals of it. And performance also has to do with, the position has to do with the balance sheet, right? And then the last part has to do with portfolio construction. That's SA. S stands for safeguard. So there's some specific ways to manage risk, predefining your risk so you're safeguarding your assets, right? And that has to do with diversification and position sizing. And the last part of that formula is asymmetry. So you want to get your return risk payoff. You always want to go for those investments that you have a potential to make way more than you are risking. So you truncate your risks and you leave your profit potential wide open. So that's it for now. But my main point is try using, when you develop some wisdom, try using acronyms and try using them to create formulas that you can call your own in your own unique process in whatever business you're in or whatever things that you do, even in teaching your children. And I think that they can go a long, long way. That's it for now. I hope you're doing well. If you have any questions, you ever want to talk to us, feel free to reach out. You can always email us at info@wealthnetinvest.com. And I hope you have a wonderful, wonderful day. We'll talk to you later.